Are you curious about investing in stocks but think it's only for the wealthy? Or maybe you've considered it but feel overwhelmed by all the charts and financial jargon? Well, sit tight, because I'm going to break down basic stock investing, explain how stocks make you money, share a simple beginner's roadmap, and even tell you about the biggest investing mistake that I ever made that cost me hundreds of thousands of dollars that hopefully you won't repeat. So let's get started, because the market's opening now. Hey everyone, this is AJ, your ace in the hole, and welcome to the channel where we simplify personal finance and provide tips for young adults and others just starting out. And sometimes we take a little stroll down Wall Street to show you that you don't have to be rich to start investing. The US stock market began in the late 1700s as a mechanism to stabilize America's financial system, surviving crashes, reforms, and innovations ever since. Today, it's a $60 trillion ecosystem containing two major stock exchanges, the New York Stock Exchange and the NASDAQ. Three of the top indices or benchmarks used to track stock market performance are the S&P 500, which tracks the 500 largest U.S. companies, considered the best overall stock market index, the Dow Jones Industrial Average, which tracks 30 select U.S. companies and is the oldest benchmark, and the NASDAQ 100, which tracks the top 100 non-financial companies listed on the NASDAQ exchange. Now, why should you consider investing in the first place? Well, one of the primary reasons is inflation. The average inflation rate is just over 3% historically, with spikes as high as 9, 12, and 14%. So if you just stash cash in a savings account, inflation slowly eats away at its value. So what $100 buys you today won't go as far in the future. To illustrate, this is what $100 looks like as it loses 3% of its value each year, reduced to $74 in 10 years and only $54 in 20 years. In other words, that new car you buy today for $50,000 will cost around $58,000 in 5 years. So, while you should always have some cash set aside for basic expenses, investing a portion of your money is one way to grow your money faster than inflation. So, what are stocks and what is stock investing? Stocks, also referred to as shares, are units of ownership in a company. When you buy a stock, you become a shareholder, meaning you own a small piece of that company. A company becomes listed on the stock market through an IPO, or initial public offering, dividing itself into millions of equal pieces or shares, each share representing a fractional ownership in the business, which are then traded on the stock market, where investors, you and I, can buy and sell shares. As a company grows or demand for its product and services fluctuates, the value or the stock price goes up or down accordingly. Companies are represented on the stock exchange by a stock ticker symbol, a short code, usually 1 to 4 letters, making it easy for investors to find and trade. Now, how do stocks make you money? There are two primary ways you make money from stock investing. The most basic is through price appreciation, or when the price of your stock increases in value. The price of a stock goes up when a company grows, expands, or increases revenue or profits. For example, if you bought one share of Tesla stock back in 2023 for $113 and you sold it for its current price of $440, the $327 of profit is yours to keep. The second way to make money is through stock dividends. Some companies choose to share a portion of their profits directly with their shareholders. This comes as a cash payment, usually quarterly. For instance, ExxonMobil currently pays $1 per share in quarterly dividends. Therefore, if you own 100 shares, you'll receive $100 each quarter or $400 per year just for holding on to their stock. You can choose to take the cash payment or automatically reinvest into more shares. Either way, you do pay income tax on the dividends when distributed, unlike taxes on the sale of a stock, which I'll touch on shortly. As far as when you should start investing, the sooner the better. But you should first establish a solid emergency savings, typically 6 to 9 months of income, and ensure you're not carrying any high interest debt. Once you have your basic finances in order, only then should you consider investing, since it does come with some risk. Once you're ready, the most common approach is to set up a brokerage account, which is not much different than setting up a basic savings account. This is done very easily at common investment firms such as Fidelity, Charles Schwab, or through investing apps such as Robinhood or SoFi, among others. Simply deposit funds and start investing. Most modern platforms now even allow fractional share purchases. In the past, if a stock cost $500 per share, it required a minimum of $500 to buy one share, which may have been too pricey for some. Now, you might instead purchase a quarter of a share, which would only require $125 in this case, allowing you to still invest, yet at a rate that meets your affordability. Also, check out my video here on IRAs and 401ks for other options to hold your stock investments. Now let's talk about risk. There is no doubt risk associated with investing, as stocks can lose value as well. And while there are strategies to help mitigate risk, there's a direct correlation between the level of risk and the time horizon of investing. Markets are constantly fluctuating up and down, with some dips and even historic market crashes along the way. This keeps many from investing in the stock market, but historically the S&P 500 has shown positive annual returns 70% of the time. That said, short-term trading is much riskier as you lose out on the positive recovery years, while long-term investing is much safer and benefits further from compounding. In fact, over the last 20 years, if you invested in the S&P 500 for any given 20-year period, you never lost money, earning an average of around 8.5%, even through the large crashes. And if you drop that to a 10-year holding period, you still only had 2 negative periods. So while stocks indeed come with some risk, the longer you hold them, the less risky they become. Another distinguishing factor between short and long-term investing is tax implications. When you sell a stock for a profit, capital gains taxes are assessed on the earnings. If you own the stock for less than a year, it's considered short-term capital gains, and it's taxed at regular income tax rates. However, if you held the stock for over a year, it's considered long-term capital gains, often taxed at a lower rate, possibly even 0%. Yet another benefit of longer-term investing. On the flip side, if you sell a stock for less than you paid, that's considered a capital loss, which can reduce other taxable gains or can lower your overall taxable income. So both gains and losses matter during tax season. Now, this only applies when you sell your stock, which is then referred to as realized gains or losses. Otherwise, any stock appreciation or loss occurring before you sell the stock is considered unrealized and are not taxed. Now, your personal risk tolerance also matters. Some people can handle market volatility while others struggle. This also needs to be considered when investing in the stock market. Discipline matters, and emotional investing is the downfall of many. Don't panic sell just because the market dips, and don't buy just because of some hype you read on the internet. As I like to say, emotion causes commotion. You should always do your own research before buying or selling a stock. Remember, investing isn't about getting rich quick. It's about building wealth over time. Be an investor, not a gambler. Save the gambling for Las Vegas. Now, speaking of emotional investing, let me walk you through that mistake I mentioned earlier. Back in 2006, I saved $3,400 to purchase my first shares of Apple stock. In the coming years, the stock rose nicely, yet in 2009 crashed down, erasing all of my gains. Later that year, the stock started recovering, and once I saw the opportunity, I sold my stock and ran away with a nice $7,000 profit. Sounds great, right? Well, had I not panic sold, today that $3,400 investment would be worth over $360,000. This turned out to be an incredible lesson, proving the benefit of long-term discipline investing. Needless to say, I never made that mistake again. Living by the words of the great investor Warren Buffett, buy low, never sell. Now, there are ways to invest to help with all of this. You see, a single stock can be extremely volatile, moving up and down daily for lots of reasons. However, there are other stock-related investment options, specifically exchange-traded funds or ETFs, which are comprised of groups of stocks that reduce the volatility of investing while still investing in company stocks. In fact, I have a future video planned where I dive deeper into ETFs, so be sure to subscribe so you don't miss that. Now, in this example, let's assume you wish to purchase shares of the company Costco. As you can see, there's quite a bit of volatility associated with this single stock. However, if you purchase shares of the QQQ ETF, which contains around 100 different company stocks, including Costco, you can see that it has much less volatility than Costco alone and allows you to invest across other companies as well. The reason is that your investment and risk is spread across many companies, not just one. ETFs have become one of the most popular investment tools and is one of my personal favorite ways to invest in stocks. All this said, a simple beginner's roadmap is to first establish an emergency savings, then invest what you can, even if just fractional shares, but invest something, and invest for the long term, and don't freak out on market dips. Use ETFs to help with the risk and invest consistently, regardless if the market is up or down, using dollar cost averaging. Dollar cost averaging is a strategy where you invest a fixed amount of money on a regular schedule, for example, a small percentage of each paycheck, no matter what the stock market is doing. Sometimes you'll buy shares when the prices are up, and sometimes you'll buy when they're down. But over time, this all averages out, taking the guesswork out of trying to time the market, which every experienced investor knows is impossible. As they say, it's not about timing the market, it's about time in the market. So here's the big picture. Stock investing protects you from inflation, gives you ownership in companies, and builds wealth. Start early, stay consistent, and let time do the heavy lifting. In future videos, I'll cover more advanced investing strategies, and if there's anything specific you'd like to see, let me know in the comments, as I'm always looking for interesting topics to help. And hopefully today's video did just that. If so, please share it, and be sure to like and subscribe, as it helps so much to grow the channel. Meanwhile, check out my previous video here for an overview of tax brackets, which might help you pay zero taxes on those capital gains. Thanks so much for joining today, and I hope to see you back here for the next one. This is AJ, your ace in the hole. See ya.